Hello, everyone. Good evening. This is Kevin with Real Traders Webinar. First off, let us just thank you for taking the time on a Thursday night to come hang out with us. As always, we try to get on, the best speakers to come and deliver the most value, to give you guys techniques and strategies that you can implement right away. If you guys could just do me a quick favor and type into the chat box if you can hear us okay and you can see Mark's screen, that would be great. Okay, perfect. Perfect. Okay, we're going to be getting started here in a few minutes. We have a ton of people still rolling in. All right, thank you so much, guys. Thank you. Also, guys, we just want to thank you for being so consistent, showing up every week. We had a great time on Bigelow's event with the credit spreads that we did before that, and we have a ton of great stuff coming up over the next few weeks. We're gonna have our weekly hangouts as always. We have our multi-speaker event coming up, and it's just gonna get better and better, guys. So tonight, what we're gonna be covering are what Mark Nicholas, founder of Day Trading Zones and contributor to Real Traders Webinar. You guys know Mark. He's one of our best. He's going to be teaching you guys how to trade the SPY weekly options. Mark, when it comes to options and pretty much everything when it comes to trading, is top notch. You won't find a better trader. He's been doing it now for over 2 decades, and as an educator, he also, can't be beat. So he's going to be coming on tonight. He's doing us a huge favor because I know he hasn't been feeling too well, but yet he's still he's toughing it out for us to come on. So what we're gonna do is, in a second, I'll let Mark come on, do his thing, and if I could just ask you guys if you could hold your questions till the end, and what we'll do so that Mark can get to his presentation, and then at the end, if Mark has time, if he feels that he could do it, he'll stay on, answer a couple of questions, and we'll move on. So Mark, are you there? And just to answer your question, guys, yes, this is being recorded, and as always, we will be sending out the replay. I know we get a lot of questions throughout the presentation. But Mark, are you there?
Yes.
Hey, what's up?
Yes. Hey, good evening, everybody. Sound test. Can you get everybody hears me? Quick sound test for everyone. I see some people from New Zealand and from Europe. So I know that the people from Europe and New Zealand and Australia, you guys are making a big, huge efforts to being here tonight because it's late for everybody. Tom, Spain, whoa. So everybody is like in the morning. So thank you very much for being here, and I'm going to try my best, even though I have a nasty cold. I'm going to do my best to give you some value and actionable things that I have been doing and that we do on the SPY. And we are going to take it a little bit opposite to what we've done with the credit spreads. We've done a 2-part of the credit spreads with Kevin, my client from Merlin Capital Management, who is an hedge fund manager, and also a friend and trader, and he's a user of my daily analysis and research. Kevin and I talked today. He's in vacation right now, and he will come probably to do a part 2 of this trading the SPY. If Kevin is okay with that, and also probably in September do something about
Hey, what up,
iron
guys? This is
condors.
Kevin.
We talked with everyone about doing iron condors, and so I think you'll find it very helpful if Kevin can help. He trades real money like we do
Muted.
every day, and he has a good spin on what to bring. So tonight I want to approach this session on helping people who just trade the futures, understanding that there is another way of trading the futures. Like instead of trading the ES, there is another way of doing it, and this way require less capital. It is the same risk as trading the ES, but the return on investment is so much superior, and I will show you in charts today and some of the options that I traded today with my traders this morning, where we made over 64% return, and I'll show you exactly the trade and I'll explain the trade. But most importantly is to help you understand how we do it. And it's not as easy as you think it is when you trade directionally. And also, you will see that it is much more powerful than trading the ES. And I don't want to get the wrong impression. I do trade futures, everybody, but I use the futures as an edge to my options trading. So if my overnight positions are overly long and something really bad is happening, the only way I can respectfully edge myself is do it with futures, and if there's a gap in the morning, is protect myself with futures. But otherwise, as far as day trading, the only thing that I trade in futures at this point of time as of August 2013 is pretty much the crude and pretty much the euro futures, but I do not trade anymore the indices via futures indices unless I use them as an edge. So let's get going. So when you trade directionally, number one, you have to understand that you have to have a segregation of accounts. We talked last about selling premium and the power of selling premium to create weekly income and monthly income via selling premium, whether it's credit spread, iron condors, selling naked puts. The entire idea of selling premium, which was the most powerful. That being said, the way I do it is I segregate accounts like this. So let's say you have $100,000, okay? The way I segregate it is I use 65% of my asset dedicated in selling premium. I use 20% of my asset in cash to be ready to take advantage of any opportunity at any time. And I use, so you are at 85% already, okay? And I use 3% maximum to 5% maximum at this point to do directional plays. And those directional plays, I do them with the weekly options. Okay, so you're at 88, 90%. Okay, and the other 10% I use them for futures, for edge intranight, or take advantage of moves that are happening intranight, because there's a lot of manipulation around our support and resistance intranight by the professionals. Okay, so this is pretty much the way I segregate. And each time you make profits on your weeklies and your monthlies on selling premium, I send this money to the bank. So the bank is right there. Okay, so each time I make money and I make premium on that money, those premium goes right there in cash, in safe stuff. Each time I make money onto my directional plays, I send the money to the bank and I pay myself every day on this money. 50% of the profit of this goes here, right there, reinjected here. And the 20% in cash here, sitting, is waiting for taking advantages. Because if you have all your money here and all your money that you get in and inside out, you always need some money to be able to take advantage of some opportunities. And it will always happen at a moment where your money is not available. And this is where you need that 20% as a cash, as a buffer. You need this to be able to take advantage of other opportunity. And they present themselves 2 times per year. 2 times per year, so it's easy. It's not like you are going to use that 20% every month. They present those opportunity at really strong inflection points on your weekly or monthly support and resistance will happen about 2 to 3 times per year. So it's not like I'm going to use the cash reserve all the time. Okay? So now let's compare, let me ask quickly in the room, who is just a future trader right now in their career, in their trading career? Who is just an options trader? Who is doing both? Just curious. So futures, just write futures, both, or options only. Just curious to see the split of the room. Interesting. Interesting. So we have a good group. We have a good group because a lot of the people in the room are either only options or both. So this is a good group because there's very few people tonight, and we have hundreds of people here. There's very few people that just answer just futures. Very few. Right, Kevin? It's either options
Unmuted.
So what it tells me right away is that we are with a group of astute traders right there. You know, done this for 20 years. You know, this is I've done this all my life. So here's what happened. If you are currently trading just futures, everybody, or trading stocks, you got to understand the way. So we are going to start with the basics, and everything is going to accelerate and getting more advanced and more advanced to the way I do it. And I'm going to break it down by Monday, Tuesday, Wednesday, Thursday, Friday, to the expiration of the weekly options, and how I do it and how I change my deltas. And I think you'll find it interesting, and hopefully you learn something. So for the people that are not sure right now, I see some people says not sure or just futures. Here's what you have to understand. You have three choices, and you got to know those equivalents to be able to hedge your portfolio properly. You have to write that down. 2 contract ES equal 10 at the money contract on the SPY weekly equal 1,000 shares. These are equivalents. But when you look at the capital required to do each, they are not equal at all. If you trade the SPY shares right now, which was about 169 something today, you would need $169,000 in capital requirement to do that trade, if you wanted to buy 1,000 shares or sell 1,000 shares. Now, if you wanted to buy 2 contracts of the ES safely or sell 2 contracts of the ES safely, you would need about 10,000 per contract. Why 10,000 per contract? Because most traders on the ES, unfortunately, they use 2 ES per contract, per trade, per contract, which is $100. And $100 is 1% of your $10,000, which is a safe number and a safe capital requirement to trade the ES. Okay? Unfortunately, that's not enough. Most of the traders that I have got to trade with, or friends that are in hedge funds still, that are hedge fund manager just trading futures, tells me that the only way they are being successful trading the ES right now, they use a 4 to 5 points. And unfortunately, 4 to 5 points for the normal guy like us, trading our own money, is around 2% to 2.5% of our account at risk per trade. Okay, so most of the traders use 2 points, yet most of the fund manager use 4 to 5 points stop loss. Okay, so that's number one thing that you should know. So if you use $10,000 per contract on the ES and you use 2 contracts, which is $20,000 in capital requirement, that's much better than buying the SPY outright on the stock, which is $169,000. But there is a much better way. If 10 SPY at the money weekly options equal 2 contract ES equal 1,000 shares, and I can get that roughly every week between 40 cents and $1.50, okay, with an average of about $1, that's only $1,000 in capital requirement. So now looks what's happening. Now what happened is I have $19,000 left. $19,000 left to do what? To sell premium. I can do credit spread. I can do selling naked puts. I can do whatever. I can create weekly and monthly consistent stream of income by selling the premium, like we've done on our 3 hours part 1 and part 2, explaining to everyone how to master the credit spread with Kevin McLean from Merlin Capital Management, right? And perhaps Kevin at the end or on the replay from tonight will be generous enough to post a link with those replays, because you'll understand the power of selling options. But what happened here is you do have the choice now. Instead of putting all your money into trading 2 contract ES, you have the choice that not only you can do directional on the SPY, buying and selling, like controlling 2 ES with $1,000, but now you can redeploy and the rest and selling premium and do trades that have a 66% chance of success to a 95% chance of success. Okay? Now, look at the risk on those trades. The risk on an ES, usually the average trader will use 2 points. 2 points times 2 contract is $200. So what you do here, you do the same. You use 10 contracts and you put a 20 cents. So you risk the same amount of money yet you use 19 times less money and you have $19,000 left to do whatever you want. Usually the profit expected on an ES during the year, a realistic expectation is 2 to 4 points for the average trader. Look here, usually when you trade the SPY and it goes your way, you can expect to make 30 cents, 40 cents, $1.50, whatever. Look at the rate of return. 2 or 4 points on a $20,000 requirement on two contracts is only 1% on your $20,000 invested. But look here now, if you trade the SPY, you can make 40% to 50%. So now instead of boring you with a slide, I want to show you a trade that I've done this morning that explained this strategy. Would you like guys to see that? Real chart and how we do the steps, real option chain, and how you think of your trade and which strike price I choose this morning in relationship to the week. And this is going to dig deeper and deeper on going into this. But I had to do this slide for the people who were not advanced, because otherwise people don't even understand why trading the SPY is more powerful than the ES or powerful than the SPY. Okay? So are we clear so far? Yes? Everyone, the futures guys, you understand? You risk the same amount of money, you make more return on capital, and you use about 10 to 19 times less money in capital requirement to do those trades. And you have the same risk. Cool. Okay, good. Thanks, Nestor, Bob, Richard. Okay, so let's go now to the graph. So first and foremost, it's systematic and consistent. You need to approach your trading by like this. So step one, it's like the credit spread. Everything needs to be consistent and replicable. And the reason you want consistent and replicable step, everyone, is because the only successful business, and you have a business here, when you trade and you risk your family's money, you have a business. It is to have consistent and replicable processes. You know, like I said last time when we did the credit spread, the power of a franchise like McDonald's is that they can take any uneducated kid and put them to a process within the branch of a McDonald's, and because their processes are so tight, everybody, they can make them a manager of the branch. Not because the person is very smart, it's because the person follow processes that are consistent and replicable. Does that make sense, everybody? And you got to cut down your trading. And I'm very serious about that. You need to cut down your trading to the same idea. I have a business. I need consistent and replicable processes to sell my premium. And I need consistent and replicable processes to make my trades. And when I come in the morning, I don't want to be the trader that puts his finger in his mouth, take his fingers out, and wait for the wind to blow and click. And each time you click, at a 50% chance of success, you are just, without knowing it, you are just gambling your family's money away. Does that make sense, everybody? So you got to rethink it completely differently, where you want to trade with higher probability of success and have those steps to be consistent and replicable. So step one for me is very simple. I have an algorithm that is a proprietary tools that what we've done, and I explained before, is I used to trade for a prop shop and I used to trade for an hedge fund. What I've seen over the years is that I used to have, when I used to prop in the professional trading firms, my firm used to tell me, well, look at this indicator on the monthly, look at this indicator on the weekly, look at this indicator on the daily, look at this cluster high, cluster low on the 60, and I used to have 4 or 5 charts. So what I've done is I combine everything that I was watching here, watching here, watching here, into one 60-minute chart, which I can trade off. So I don't have to watch 4 or 5 charts. I have everything in one chart with buy zones, sell zones, and caution zones. That simplifies my life. And then what happened trading real money every year, I tweak the system based on hard blood and hard sweat and successes in trading. Does that make sense, everybody? So it was a way to condense everything. you as a trader, you still have access to whatever you use on the monthly, the weeklies, the dailies, the 60-minute, the tick chart, the 3 minutes. And by the way, all of those are crap. To me, anything below 60-minute chart is crap. Okay? And the reason it's crap is because I explained on the previous webinars, you are competing against the high frequency trading system that trades in nanoseconds. They trade in nanoseconds, you have no edge with those guys. So if you have no edge with those guys, you got to trade with the higher time frames. Everything above a 60-minute chart gives you information that the high frequency trading system have no edge. They cannot. There's too much power, too much support and resistance on those higher time frames. There's a lot of institutions that pile in at those time frames. If you go below those time frames, that's where they do. Yummy, yummy. I can see the order flow on the bid and the ask. They can see their level 2. They can see the deepness of your orders, and they'll take all your bids and all your asks, and that's how you see the Googles and the some of the stocks that sometimes have low liquidity, especially in a month like August. What they'll do is they'll kill you. They'll wipe out. That's what you've seen here. You've seen the ES going from 96 to 88 this morning. They held perfectly the cluster back up. Okay, and the reason they are able to do a late afternoon squeeze like this is because the high frequency trading systems are able to take very low liquidity and can read it. And then what happened on those major buy zones, sell zones, like here, see, this was a major buy zone. You keep on saying net seller, net seller, net seller. Remember I told you when they touch 3 times, you put a short on the high candle here, 50% of your size, then it cross the day trading zones, retest the day trading zones with a lower high, you put another 50% of your size, 50% of your size, you have an average there, and then it goes all the way to the caution zone. Okay, and so here what they did is a recross, and they retest the buy zone, and they fell it this morning. They tested at the open, and boom, fell it. So what you got to do is you've got to start by your charts. You got to spend time in the morning and look at your support and resistance. If you are not mastering support and resistance, you cannot master spreads, you cannot master selling premium, and you cannot master directional plays. And one of the reasons being is this, is because the options player look at the delta. The delta is the most important number in options. It's the correlation of the underlying move with the premium move, but it is also the correlation of your probability of success, and it's also the correlation of how many stocks do you own in relationship to the underlying. You know, when you have a delta 50, it's like owning half of a share. Okay, so all those correlations are powerful, but what is the weakness of the delta, everybody, in an option chain? And the weakness of the delta, anybody knows? What would be the weakness? If I look at the delta this morning on any weekly options, or a delta for next week, what is the delta? The delta is nothing more it's nothing more than an assumption. It's nothing more than an assumption from the most astute traders, which are the options traders, which are usually pension funds, hedge funds, professional traders. Is nothing more than an assumption from the professional trader for today. And the problem, the weakness of the delta, is that the delta is not as strong as those zones or your dailies, your monthlies, and your weeklies. Because your monthly, your weeklies, and your dailies, and your 60-minute charts, support and resistance, you'll be surprised, everybody. They are more powerful than the delta of today. That being said, when you do charts, or you do monthly credit spread, or you do weekly assumptions, and you do weekly directional plays, that being said, you confirm them with the delta, but it's nothing more than an assumption for that day. Does that make sense? Quick yes or no? It's very profound. A lot of people just trade based on delta, and it's a big mistake because the delta is an ever-going thing. What happened on your delta? If you make a trade based on an 85% chance of success with a delta 85, the night of the earnings on Google, and the next day Google has a market maker move of 50 points, and you multiply that by 1.5, so 75 points to have an 85% chance of success. If you do that, guys, you're completely wrong, because the next day, that 85 delta today could be a 40 delta tomorrow. Does that make sense for everyone? Because it's very profound. It took me years to understand that. Okay? So essentially, your first step, and that's why I'm spending some time here, your first step needs to be your charts. Anything that you do must be your charts. Okay? So here's the total example of what happened this morning. And that's a real trade that happened this morning that I recorded with our traders. It was recorded. So here's what happened for the past few days on the day trading zones. You use your own support and resistance. You had a cluster high. You can see it visually. You have a cluster low. You can see it visually. Net seller here, net seller here. Third touch, you have 66% chance of success on the short here. It crossed the day trading zones. You can add here, or you wait for the lower high here, and some people wait for the retest here again one more time. So this morning, it did retest, okay? And it went all the way to the 88. And if I compress a little bit, and it's important that you understand the concept of cluster, which doesn't require any tool. If you see a little bit what I call here, if I put my cursor right there, and I do, you know what, guys? I need a light. I don't have a light in my office. Hold on one sec. I cannot see my keyboard. Hold on one sec. So if I put a line right there, and you always want to spot those cluster high, cluster low. If I put a line right there, everybody, does that make sense as a cluster high, cluster low? Quick yes, no. Tell me. I'm not going to make it a little bit higher so that you understand. Where you have net buyer, net sellers. Yes? Okay, cool. Thanks, Michael, Françoise, Nestor. And by the way, whether you are an investor, whether you are a day trader, whether you are an option seller, you always want to have an idea of those clusters on your 60-minute chart. I use them, and on my weekly chart. What is a cluster high, cluster low? Someone is asking me. Here you have a net buyer coming. Here you have a net buyer. Here we have net sellers around here, net cross recross, net sellers, net seller, net seller, net seller, net seller, which is the resistance become now the support, comes back here, support, support here with a cross recross. Was more accurate by touching the day trading zones to the tick yesterday, right? Came back down. So cross recross all the way to the caution zone, retested one more time the buy zone this morning, and it was good for 20 points. So let me show you how I played. So now you have two choices. Choice A, you trade the ES. So let's say you are a genius on the ES this morning and you made about 10 points. You would have made $500 a contract. Do we all agree for each $10,000 in capital requirement for an ES? Okay. So $500 divided by your capital requirement of $10,000 per contract to be safe on the ES is only 5% return on the ES this today. And that's assume you are a genius. You took the top of the buy zone all the way to that cluster, cross recross 86, you're out of that trade. Now, look at what we've done and the options are doing with less capital requirement to be safe. I'm going to the option chain. Can everybody see the option chain? Okay, thanks, Frank, John, Richard, everyone. So here's what I've done. This morning, I took at the open, because I saw the cross recross retest on the buy zone, I took the 169.5 put. So I got to the 169.5 put, and can you see that chart? So now this is the chart of the 169.5 put this morning. So it opened here around 33 cents. See, right there. 24, 33 cents. We bought this at 45 cents and 48 cents this morning. Okay? We unloaded this at 78 cents. It went all the way to 83 cents. And then we were out. So didn't get the perfect 24 cents bottom. I didn't get the 83 cents, but that's what happened. So we started 5 contract, 45 cents. I did 5 contract, 48 cents. So let me show you now. Now I have my 10. My 10 contract equal 2 ES. We've just saw that 2 ES today, or 1 ES, let's say 1 ES, you made 10 points. And 10 points divided by $10,000, just to keep it simple, was a 5% return. Now look at it, and that's explained the slide that we've just went through with real trading example today. And so now what we did, we took the 169.5, and I will explain in 1 second why the 169.5 on the charts and compare that to the option chain. So now we did on that trade about 66%, 64%. So you think about it, we exited at 78 cents minus let's say 45 to 48 cents. So my cost basis was 46.5 cents. Yep. So again, you take 78 cents minus 0.465. It's 32 cents profit divided by 0.465, and you have a return on investment of 68%. So you have 68% return here versus 5% return here. And now my capital requirement on those 10 contracts was $470, let's say. Capital requirement here would have been 2 times 10,000, would have been 20K. The stop loss was 20 cents, 200 here, 200 here. Does that make sense, everybody? Quick yes, no. So do you see the power of this? Number one, it shows that everybody in this room that have less than $30,000 should not trade the ES period. You should trade and focus on selling premium and focus on doing the SPY directional with very small size. And I'm going to tell you. But this is the power, everybody. This can literally change your life. Okay? But the trick is that options are not easy. If they were that easy, you know, we would know that. So you got to understand how an option works one more time. I'm going to repeat that one more time. I'm going to take and explain to everybody why it's dangerous and why I trade the weekly, and I'll do that. So now I want to go back to the option chain before I jump back to how the options work and the mechanics of the options. And I want to show you one more time the charts. When I came this morning, they did a retest of the 170.16. So the first question everybody should ask is, why did you take this strike price? Because I was not in the money. I was right below at the money when I took the trade. See, I was around 170. I didn't take the 170s. Delta, the delta on the 170s were already 68 or whatever. I took the delta 48. And this is where you are going to start. This is going to be where things start being a little more advanced. I took a 48 delta, and that's more for the advanced people, versus a 68 delta. So here's what I do, and I'm going to go back a little backward. Options, weekly options works like this, everybody. They open on Thursday. So Thursday, Friday, Monday, and bear with me because it's not easy. It takes years of experience, but you are going to get it as you watch and watch again. Monday, Tuesday, Wednesday, and Thursday, and we are back on Friday. So here's what I do. Okay, here's what I do. Usually on Thursday, Friday, I use a delta, and I'm going to make it even easier, the delta. I trade at the money or one strike out. One strike, don't go 2 strikes, you lose money. One strike out at the money. On Monday, Tuesday, and usually Monday, Tuesday, I trade a 70 delta, which means I trade in the money. Okay? Like most of the money. If I have a directional bias, I want to make sure that the correlation between the underlying and the option is maximum, but I don't want to overpay with it. So I buy a 68.70 delta. Again, Wednesday, Thursday, Friday, I go at the money or one strike out of the money. Now we're becoming more advanced. Okay? Now, the reason that I do this is because, as I explained last month when we did the credit spread, is because the acceleration of the time value decay on the weekly options start happening on the last hour on Tuesday, everybody. They happen on the last hour on Tuesday. So what happened is the time value here on Monday is about stable, a little bit down. Here on Tuesday, a little bit down, they start accelerating on the last hour. But now, Wednesday, Thursday, Friday, woo, it's going fast. So you are fighting against two things on Wednesday, Thursday, Friday with your options. You are fighting against this. If this is an option, and we're starting to be more advanced now. Where can I do this? Maybe probably here. This is going to help everybody better. If this is an option, and this is a $1 option, this option has three components, everybody. Three components. Bear with me, guys, because this is very powerful. You know, this is how people get millionaires, and that's how people become wealthy. You are not going to be very wealthy trading just futures or just Forex. You need to have other tools in your toolbox. And the most powerful tool in your toolbox is really be a master at support and resistance with options. So look, this is a $1 option, everybody. This option has three components. That's where you are going to start understanding all the basics and everything flow. One of the components is called time value. The other component is going to be real value of the option above your strike price. And there's one component that is not understood very clearly by newbies, is the volatility. So let's say that in time value on that $1 option, I have only 20 cents. Okay? Let's put 30 cents. And this one, 35 cents is going to help me. 35 cents. Then you have a real value, let's say, of 40 cents. And let's say we have a 75, then we have 25 cents less left in volatility. So now the first thing you need to understand is that this asset that you just bought for $1, I'm going to change, no, I cannot change the color. This asset that you just bought for $1 is going to change. It's like an organism that is going to change every day in your weekly cycle. So remember, it opens on Thursday, Friday, and you see this is completely opposite of what we've done last time, but when you understand both sense, then you start mastering everything. Tuesday, okay, and Wednesday, Thursday, and Friday, everybody. And what I share with you guys right now, it's based on trading those every day with real money. Okay, so it's not like, and as you can see, my slides, since I have no slides, I'm teaching you like really out of the guts here. I didn't really prepare. So here's what happened. So Thursday, Friday, Monday, Thursday, Wednesday, Thursday, Friday. Okay, cool. That 35 cents is the theta. It's called the time decay or the time value of the option. It keeps on going down, 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 but it's not coming down in a linear fashion. The first day might be linear. It might lose only 7 cents. You take 7 days, divide by 35 cents, it might lose only 7 cents. Then on Friday, might lose only 7 cents. On Monday, might lose also 7 cents. It's kind of linear, or maybe 8 cents. Then on Tuesday, it goes 8 cents, 8 cents, and cents. But here you have to understand the hours. That's where the professional understand that. At 3 p.m. on Tuesday to 4 p.m. on Tuesday, this is no more 8 cents. It's going to be like 9 cents quickly. And then it's going to accelerate. Here it's going to be 11 cents. Then it's going to be 12 cents, whatever it's going to be. And by Friday, it's going to be like, let's say 15 cents. By the time it's done, by the time you do the entire week, you lose this to zero. So the asset that you bought on Thursday, let's say, at $1 that looked like a good deal to you guys, will be left at the end of the following week when the option expire worthless. This will be a zero. which means that essentially if this real value doesn't change and that volatility doesn't expand or contract, what will happen is your asset essentially is worth only 65 cents, which means you have been the sucker who bought a dollar asset that is now worth 65 cents. So the way you day trade, you have to day trade those weeklies is in and out for the day, okay? Most of what we do is in and out for the day to replace the ES. If you have a great assumption and you think that it's going to continue, write that down. Never leave more than 30% to 20% of your entire size for an overnight. So it means what? If you have made good profit on 70% to 80% of your size, take it that same day because you are fighting against that time decay every day. Does that make sense? Quick yes and no. And now I'm going to explain why I changed the delta for the week. And that's why I'm changing the delta, because I want to be able to compound to the fight of that lost time decay. Okay? And it's a little more advanced, but it's great stuff. So here's what happened. On Thursday, Friday, Monday, Tuesday, blah, 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 the time decay for the following doesn't change too much. So if you trade the following week options, I would go 70 delta here, 70 delta here, 70 delta here, 70 delta, because your time decay is not too bad. But here's what happened here. When this starts accelerating, the time value, the time decay is accelerating against you, I go with lower deltas, which are cheaper options. And usually the cheaper options, what happen is I go, again, at the money, so you don't need to break your head, say, Mark, what exact delta do you do? The rule is this. On Wednesday, Thursday, Friday, go at the money or one strike out. That's it. That's the most simple way I can explain it. And this morning, if you look my option, the one strikeout that I bought at 45 cents and 48 cents was the 169.50. Remember, we started the day around 170.10. So I went to the 169.5. The 160.70 was at about 70 cents to 50 cents at the time. This one was at 24 cents. This one went up. 150%, 152%, I'll show you. And this one went up 160%. But this one in capital requirement would have been with 10 contract. With 10 contract, this one at the low would have been $500 to $700. This one at the low was $240 to $330. Me, I timed it at 480 here, and by the time it was 480 here, this one was already 800. So my capital requirement was less, my delta was less, but it expands very fast. It expands almost as fast, but my total risk is almost half. And the reason I go out of the money, everybody, is this, and this is where you are going to understand why I'm going out of the money on Wednesday, Thursday, Friday. Do we agree that Wednesday, Thursday, Friday to buy the weekly option is dangerous? Yes or no? Because the acceleration of time decay. All the people that are an option astute trader here. Yes or no? Okay, so people start getting it. It's wonderful. So here's what happened. If we know that Wednesday, Thursday, Friday, they are dangerous, why should I buy a 70% chance of success on my assumption? Because what happened, 70 delta is the correlation. If the SPY move 1 point, if the SPY move 1 point up or down, my option will go up or down 70%. So can we all agree, if this morning my one strikeout or at the money, my delta I think was about 48%, okay? Do we all agree that if I am wrong, and that's always what I'm focusing on, protecting myself. If I am wrong, do we all agree that the 70 delta is going to blow up on my face faster than the 48 delta? Quick yes or no? That's why this is why I trade the lower delta on Wednesday, Thursday, Friday. Does that start making sense, guys? Putting all together right there in one slide. It's powerful, huh? And thanks everyone. This is stuff that, guys, even you trade options for years and years. I trade options for quasi 20 years, everybody. Okay? So this is stuff, when you start understanding that, you say, whoa, I didn't think about that. But me, I just want to do one thing, is I know it's a gambling trade. I know I'm doing a directional trade anyway that has a 50% chance with an over 50% chance when I use my tools and my day trading zones, daily analysis with our support and resistance. But I know that me as a trader, I have one goal and one goal only, everyone. It's to do what? It's to protect our principal. We as traders we have only one goal, everybody. It's to protect and grow our capital and principal. If we lose our principal and capital, unfortunately, we lose our tool to make money. You know, you have the guy who come and repair your roof. His tool is a hammer. A tennis player, his tool is a tennis racket. A golf pro, his tool is golf clubs. If we as traders lose all our money, we are out of business, everybody. We are out of business. So we got to protect it. When I go one strike out and out of the money, essentially what I do is, do I reduce my loss almost by 50% compared to this guy? If I buy one contract here and it blows on my face, and I buy a 40, a 30, 50 delta, and I go against this guy, I save myself 30 to 50% better in terms of losses than the guy who goes deep in the money, especially when there's acceleration of delta and the moves are very sensitive on the weekly. Does that make sense, everybody? Zachary, everybody, keep your questions. I promise I will stay, even though I feel like crap. I promise I will stay longer to answer everybody's questions. If I have to be in bed all day tomorrow with fever, that's fine. I'll be in bed all day tomorrow with fever. That's what I do. This is my passion. Okay? But let me just finish the limited amount of energy that I want to use there. So see, this is how we went. So again, we looked at the charts and we were at 175 and it made sense at the open for a short with a cross retest, trade setup number 3, lower high. Then we went with the add the money, one strikeout because we are Thursday. Then it worked on our favor. We just invested about 30% to 45% less money than the 70 delta. And we made almost the same return on investment. And that's it. And the stop loss was the same as an ES, 20 cents, 200 bucks, 200 bucks. The rate of return was 66, 68% I showed you. Okay? And this is the power of the weekly, guys. This is Jim, don't worry. I mean, you can tell by my voice. But anyway, this is very important and this is key. Let me show you now the graph of the two contract. So let's go to the 169.5 I took and looked at the chart. The low of that stock was 26. The high of that stock was 83. So look the rate of return from low to high. 83 cents minus what we say, 24 cents. It's 82 cents. 82 cents divided by the 23 cents. It's almost a 360% return. Is that what it is? Yeah. So 360%. That was the one strikeout. Now let me compare that to the one that was more sensitive at the open, which is the 170. Do you guys want to do that? Which illustrate what I say. Quick yes, no, because I'm about to do it. Okay, cool. Because this is very important. I mean, this is just a fact why it works on Wednesday, Thursday, Friday. And then I'm going to show you why the professional also reiterate what I just said. So now look at this one. This one, which was more in the money, close to that 70 delta, 66, 70 delta, open at what, 52 cents and went to $1.16. So $1.16 minus 52 cents, everyone, is 64 cents. 64 cents divided by your 52 cents entry, it is just a 123%. So look at this. Did I just made a point? 123% versus 360% on the one strikeout. Yep. And the capital requirement was about 30 to 45% less. And the risk was 30 to 5% less, because when it moves down against you, it moves down with a lower delta, a lower correlation. Is that profound, everybody? Because I cannot show it better than this, guys. This is, you know, it takes years and years and years and millions of dollars of trade to come tonight in a 1 hour sharing that for nothing, guys. just to share that with for the community. You know? Years and years, everybody. You know? So, okay, so here's what I want to show you, why I am not the only one to think that this is profound. And this is the way to do it. Now, do you see that on my option chain, I'm going to change the probability of touching. I use IB a lot. Most of my trades are done on Interactive Broker, by the way, but it's easier to illustrate here. So look here, I'm going to illustrate this with the open interest here. Okay, here. So can you guys see? And we are going to take only 8 strike. You'll see it even better, everybody. So do you guys see the volume and the open interest, everybody? Quick yes, no. Okay, so here's what happened. Okay, Jeff, Richard, make sure that you hold your questions or paste copy your questions when I'm going to take the Q&A in 5 minutes. So here's what happened. Do you see the volume and the open interest? If you look very closely, look at the highest open interest on those things. We close at 169.92. Look at the highest open interest. It is right there at 169. Yes or no? So is that out of the money or in the money for the puts? It's out of the money, right? And look at now. So usually what you look is that the players are looking at a support here around the 169, and you look at the things here at 170, and they are expecting this thing between tomorrow to stay between 169 and 170. That's also how you can confirm support and resistance with your open interest. But look at the volume today. The highest volume was done on the 169.5 and the 170s. And look here, the same. The highest volume was done on the 169.5 and the 169. And I took the 169.5. So do I confirm when I took that 69.5 with the highest open interest and volume, do I confirm that I was part of trading with the most astute traders in the nation? Yes or no? All the professionals. Do we confirm that by looking at the open interest and the volume? Okay, great. So this is how you put everything together. I think, guys, if you watch that webinar again, and watch the credit spread webinar, which was part 1, part 2, part 2 with Kevin McLean. Guys, I'm telling you, you have 4 hours of preciousness that people sells you $1,000 in a 1 day or 3 days webinar BS. Okay? To me, the only time where you have to train traders is you have to make them repeat live with real money, at least for 2 weeks intensive, or 3 months or 1 year, but anything less than this is BS. Does that make sense, everybody? You know, you don't learn 20 years in 3 days, and you don't learn 20 years in 1 week. It's just not happening. You know, everybody who sells that soup doesn't work. Okay? So I think that you should watch again and again and again. I had some slides, but those slides that I have here are very similar to what we've done last time, explaining the power of the time decay, the bell curve, and everything else can be, and the setup for the trading and mastering support and resistance. And I have a live event next Tuesday, if you want to come, where we look for opportunity. But this is stuff that we went over on the 3-hour webinar, so I don't want to bore you to death. If you have questions and answer, there's a lot of very good questions. Unfortunately, I had to finish this because I'm telling you guys, I am like borderline dead. You know, I had fever last night, and today has been pretty bad. But go ahead, please shoot me and shoot me the questions. So if you have some questions, also if you want to learn more about what we do, you can get a free PDF on how to master support and resistance and probability trading with free training video on our site that Kevin can give us.
I just posted the link, guys. If you look in the chat box,
yeah.
it's realtraderswebinar.com/DTZ free. It's right there in the chat box. You can get Mark's PDF and
yeah,
videos.
I mean, you just put, you just get that. You don't have to pay anything for that. And if you're interested about our daily trading research and analysis and how we overlay mentoring and trading with you guys live, you can take a look at our charts. But most importantly, get those videos and those ebooks because they also confirm the basics of looking at your charts and how you trade those trade setup. So now I'm going to answer questions now. Thanks, Brenda, Richard. So let's go one by one. I'm going to, please, before you, could you do me a favor? Before you put your questions, let me answer the question I'm answering, because what happened is there's tons of people, and what happened is each time you answer a question, it goes up, and I don't see it. So it's not like I don't want to answer it. It's just I don't see it anymore into the box of question and answer. So,
and guys, just to let you know, I can share. We'll send out the links to the replays for the credit spreads hangouts that Mark is talking about. When we send out the email with the replay of tonight's hangout, we'll also include the links to the replays for the credit spread hangouts that Mark did, the part 1 and part 2.
Richard, not sure of the difference in deltas in your question. Not sure on the difference of deltas. I mean, if you have TOS, you and I should have the same deltas. I mean, hold on, Nelson. Okay, Nelson has a very good question that I want to reinforce. It says, can you please repeat the breakdown percentage for income allocations? Okay, are you talking about the breakdown of the 65%, Nelson? Or you want me to do the breakdown of the entire portfolio on the diversification? Just let me know so I don't break my voice for nothing. Sorry, guys. Is that just on the 65% of the premium collection? Portfolio 65, 20, 10. Okay, so we repeat. Okay, so again, if you have, I'm going to make it that easy. If you have a $10,000 account, everybody, if you have a $10,000 account, you should have $2,000 in cash. You should have 65%, 6.5% in selling spreads, okay? And you should have 3% to 5%, so $500 into your weekly options, okay? See, very small account. Now, here's what happened. Is you are 8.5, you are 9, you don't have, you see that extra 1K, you don't have the room for futures to trade the ES on a $10,000 account. So what I would do with that 1K, I would go back here and plug them into your weeklies so you can do decent weeklies. And that's it. So now, if you have a $100,000 account, the way I would break it down again is 20,000 cash, $65,000 in selling the options. On the weeklies, I would go 3,000 top, and then you have 12% left. I would go 12,000 for your futures, yeah. And that breakdown here, Nelson, goes like this. And that depends on your capital, and that depends on what you have. But most of us here can trade credit spread because they are well defined and the margin requirements are not there. But what I do is mostly credit spread between 68% to 75 to 80% deltas on the weeklies. I do 75% to 95% on the monthlies. And when I do naked puts, okay, I sell premium on naked puts. I look for 75 to 95 delta minimum. I want the higher delta because I'm taking more risk and more margin requirements. So those are the basic strategies. And I have other strategies that are more advanced, like the double diagonal or butterfly, but I'm not going to go there. It's too advanced for everyone. Then what you want to do is having a plan for your weekly options versus your monthly options when you sell term decay. They are not the same plan. How much premium you want to collect, the stop loss, the size, etc., etc. But that's how I break it down. And then, of course, you have your bank account here. And now with SCH transfer with every broker, you can transfer money here every day, every day, every day, every day. Transfer here, forget about that money and do safe stuff with that money, diversify in other things than trading. Okay, next question.
There's a lot of people that are asking about how they can mentor with you. We have a bunch of questions, Mark, asking they would like to train with you. What would you send them to?
What I would recommend first is you get the free ebook and the training videos, because that'll give you some ideas and complete what we talked about tonight. Look about our daily analysis, because if you don't master support and resistance and understand where to enter your trade, whether you are a stock trader, forex trader, options trader, or futures trader, doesn't matter. You're not going to make money. And kind of understand the philosophy and follow us on our live webinar, and see later on if the mastery program or the training that we do live are something for you. But I would certainly just start at the free book training videos and the trial on the daily analysis. That's the starting point, really. Let me answer. So Tom, the webinar, I think he answered. By the way, Tom, thanks for coming. You are the guy from Spain. So thanks for coming, because Spain, just to let you know, in Spain, right now it's about what, 9 plus 6? It's 15, it's 3 o'clock in the morning. So thanks for being here. Scott, we answered that. Tom has a good question. He says, are you not subject to day trading requirement of $25,000 for trading options? You can trade with accounts smaller than 25,000 with options without the 25K day trading. It's a very good rule. I had an argument with a guy one day. He just was not listening, like by email, going back and forth. And then on the forum, he said I was saying wrong. Guys, here's how it works. If you open a margin account, you are going to be submitted to the PDT. And the PDT is something like this. If you do 4 round trip for the week, boom, they tag you as PDT. So if you want to do those weekly options, here's what I advise you. This is the trick for small account below $25,000. You open 2 accounts. Let's say you open an account at IB and you open an account, let's say at Interactive Broker or whatever. It's the same. Interactive Broker and TD. One you open, it's called a cash account. They will let you buy and sell the weeklies with no restrictions. Remember, cash account. And they will limit you to the cash you have in your account, which is very safe and very profound. Instead of going crazy with margin, they'll let you just trade the cash available in your account. So if you have $10,000, you do 3 trades for 3,000, 3,000, 3,000, then that's it. You're done for the day, which is great because it limits you also on the numbers of trades that you do instead of trading like a gambler. So what you do is you open a cash account with one broker, and you open a margin account with the other broker when you do not day trade more than 4 day trades per week, where you do your credit spreads. So you could open an account. You have $15,000, or $20,000. You put 10, not 10. You put 2 for your cash, your weekly options on the cash account, and you put 18,000 to the margin account. Does that make sense, everybody? Yes or no? Because very profound. I'm giving you the key to go around the PDT, everybody. You know? Yeah, a lot of people does not that. It's my gift to you, everybody. Okay? So other question. Okay, Joe is asking, you ladder in 2 position Joe asked me, you enter, meaning you scaled in 2 position on the SPY. Did you scale out? I did scale out, Joe. Yes, I did scale out. So usually the scaling out strategy would be like this, because those options are going very fast. Joe. So because you trade the weeklies, they are very fast. So you want to trade like this. Either you go all in, all out, or you go 50% in, 50% in, all out, or you go 50% in, 15% in, 50% out, 50% out. The reason you want to reduce the number of click, Joe, is because you need to be very fast on those weeklies. You know, remember it's a day trade, and when you get that 66% return and it hits your day trading zones support, you got to get out, because otherwise you've seen the option crashed after that. Did you see that, Joe? So does that make sense, everybody? So you want to reduce the numbers of clicks, everybody. This is key. You want to reduce the numbers of click, everybody. Next question. Not sure I understand your question. Richard writes. Next question. How do you break down? Daniel, I have news for you. I don't know how to break on an IRA because I don't have an IRA. So I just don't have an IRA, Daniel. What I would do if you have an IRA, or it's called an IRA or an IRA, anyway, a pension fund from the US, what I would do is if you can do the spread, just do not reinvest just 50% of the profit. So make it like you pretend like you 50% of your profit are just cash and you never reinvest it if you cannot get them out without a penalty. Okay? Next questions. Okay, John has a good question. Do you suggest using the SPX instead of the SPY? You know, John, commissions are everything in trading. They are going to be your biggest cost. I agree with you. That's why you have to be very careful with your broker, because some brokers out there rape you, and I'm not going to tell you who. You know who it is in options. I like the SPY, and the reason I insisted on the SPY, I trade some weekly sometimes on Google and Apple because I have a very strong confidence on my directional, but they are very much more dangerous. To me, you guys have to control and master SPY. If you don't master credit spread on SPY or directional plan SPY, you master nothing. Look, Kevin McLean, he came last month, and all he does is SPY. The guy has traded 10 years. He makes money, tens of thousands of dollars every day. I have a friend who makes millions of dollars. He trades for an hedge fund that manages over $300 million. There are six traders. They have a rate of return of over 76% every year. They sell premium all year, and they had less than 5 losers last year by just rolling over their losers. And all they do is indices, guys. You would be surprised that the most astute and professional trader, they don't touch the Google. They don't touch the Apple. They don't touch the crazy stuff. They know better than touching those crazy stuff that blow up in your face. You know? I don't know in this room if there's any of you that can tell me I trade Apple and Google weekly directional puts and calls consistently making money. I would say out of the hundreds of people in this room, there's probably 2 guys. Does that make sense? Next question. No, D is asking me, did you trade the options both directions today? No, D. After I get one move in the morning, I'm done. Most of the mornings, I'm done by 11 o'clock, I'm done. Next questions. Thanks, Joe. Rudy, we tried to answer that, I think. I do it every day in my TOS account in my IRA. John says he does it every day in his TOS account. So in doing IRAs. Olga said, would you pay attention on candlestick? Well, it's funny you say that, Olga, because I've traded almost 20 years. I started when I was 20. I'm 41, you know, and there was I know 3 candlestick pattern, and when was that? Steve Bigelow came 2 weeks ago. Anyway,
yes, it was.
We had, yeah, there was Steve Bigelow presenting here, and I came. I attended the webinar, and I wanted to learn more in other candlestick pattern, because you know what? I think as a trader, we have an evolving trading journey. We never cease to learn. We never cease to be better traders. So I think, I'm sure you can learn good stuff with candlestick pattern. I listened, you know. I have one of my top traders that is 70 years old, who was a commercial professional trader in Houston in the oil business, John Pennell. And John learned from me. I learned from him. You learn always during your trading career a little bit, a tidbit that can change, like your golf swing, that can change your entire trading results, everybody. So good question. Next, John, Google can smoke you fast, and indeed it does. Uh, Rosemary, I can't. Rosemary says, can you hint on bad commissions broker? At least I can't. I just can't, Rosemary. I am not here to blast anyone. I'm just here to tell you what I've done in my life with real money, what works for me, how I can share with the community, but I'm not here to blast anybody. I would love to tell you who I think is raping you in commission, but I can't. I used to do that, and I think it's not professional. Yeah. You trade on. Are you trade on the SPY credit spread? Chang, I do not only trade credit spread on the SPY. I trade credit spread on the SPY a lot, but I do everything. Everything that has high volatility, Chang, and shows up on my chart as a high volatility play, and that makes sense, before the earnings are released or something like this with extension and compression of the volatility, I'll play. I don't care. I'm here to make money. I'm a trader. I'm not, but if you trade directional, your higher probability of success will be on the SPY. And thanks for staying, guys. You guys are smart, because you know on those Q&A you can learn a lot of stuff that may not be recorded. Right, Kevin?
Yeah.
Like Kevin, sometimes I see he cuts the recording like at 1 hour just to make it good for the replay. Thank you, Olga. Appreciate your comment. Other questions? Do you only trade the weeklies? No, Robert. I trade the weeklies and I trade the monthlies, and sometimes I do debit spreads on the LIPS, the 1 year and 2 years options. That's what I love about options, guys. They are very versatile. They are very well defined in risk, and they are the best thing you can ever trade. You just cannot find. You just cannot find. Hey, John, thank you so much. Look at this comment from John. Thank you so much for the comment. That's cool. Look at John. Is that John Pennell, by the way? I don't know whose John it is. How do you know which John? I don't see the last name.
Yeah, it just says the first name, Mark.
You hide the last name from me. Huh? I don't have the credentials to see last names tonight, unless they put their last name. Next, who is best in commission? Someone say, okay, so can you tell us who is best in commission? Well, look at the Interactive Broker and compare with others, and you tell me. And I don't make any money telling you that, by the way. Chris, it might help if you told them what to look for in a good broker. Okay, what to look for in a good broker? Well, number one, I would look for that, especially if you trade with just futures brokers, I would like to go at the NFA, make sure they have no case against them, and I would be sure that I don't put a lot of money. You don't want to be the poor guy that gets sucked into a PFG or one of those Madoff or one of those crazy stuff. Go with publicly traded company and segregate money, guys. I would never ever put all my money in one broker, period. If it's the best broker of the world with the best commissions, I don't care. I will never put all my money into one broker, period. So hopefully that helps you. I'll be closely studying. Thank you, Nelson. Thank you, guys. Great comments coming. Nice feedback. Other questions pertaining to what we've done tonight? I'm glad to answer for another 5 minutes, guys. It's already almost an hour and a half. Okay, let me try to go David, you're welcome. Thank you for coming. So let's say, so my question earlier was on IB platform. Do you get the same delta already as another platform like TOS? Yeah, I mean the delta should be very close, Richard. I don't know how each broker compute their option chains, but it should be very close. You know, it should be very close. Okay. Kuamasa, thank you. Very appreciated the feedback.
There's
Thank you.
John's name. John Orrock
No, so that's not my John.
from Omaha.
John is asking, have you ever tried the IWM? Yes, very good, John. It's a very good one to trade. Do not trade the Qs. The Qs is a sucker. Thank you, Barney. It's your sucker. Don't trade the QQQ. I don't make a lot of money trading the QQQ for some reason. Okay? Don't trade the QQQs. Anne, you're welcome.
The rest, I think, is just positive feedback, Mark. It's just a bunch of people thanking you for your time. Unbelievable feedback.
Hold on, Isaac Creed. It sounded like you preferred to belong the 50 delta over the 70 delta option 2-3 days before expiration, but these have a highest theta. Did I misunderstand you? They don't have the highest theta. They have the lower delta as the low. They have the highest extrinsic value. But I explain why. I risk less when there's a compression. If I'm wrong, watch the replay again, Zachary, and you'll understand why I do it towards expiration, because that's where the options are most sensitive. And if you are in the 70 delta and you are wrong, it's going to be very sensitive and it'll blow up in your face very, very fast. Nestor, what's your opinion about trading binary option on the NASDAQ or whatever? I have no idea. I think it would be great if Real Traders webinar puts their head into it, and maybe we'll invite some guys from there. I have no idea what it is, tell you the truth. Okay. What about the OUT? No, Jeff, I prefer IWM. It works better for me. Better for me. He says, Chris, thank you. He says, much better than any mentorship I have attended. Thank you. Did you see that, Kevin? That was nice. Merci from Cambodia. Wow, thank you for being here from Cambodia. That's it, guys. I think we've gone through a lot of questions. There's a couple of hundreds people still left courageous. Thank you so much for coming. I hope I was able to help you with my broken voice and my...
Mark, you did a great job. Thank you so much.
The French accent plus the broken voice, that doesn't help.
I think Brenda's comment says it all. Brenda said, this presentation is so clear. It's the best use of a training hour I've had in a long time. Thanks again. Outstanding info shared. And it's just been nonstop feedback just like that. Thank you so much, Mark, for coming out sick and all and giving one of the best webinars we've had.
Thank you, Kevin. And again, guys, if you're interested in what we do, follow Kevin's link. I'll give you access to the free ebook and the free training videos. And if you want to take a trial on our buy zone, caution zones, and sell zones to see how it can help your trading.
Yeah,
have a nice evening, everybody.
Just to let you guys know, so the replay will be sent out, guys, within the next 24 to 48 hours. You're going to get an email. We'll definitely include the link to this replay, also the replay about the credit spreads, the part 1 and part 2, and also, yeah, don't forget to check out realtraderswebinar.com/DTZ free, where you can opt in for Mark's ebook. You'll get some videos emailed to you also. You'll be presented with the opportunity to take a trial for Mark's daily analysis, and he'll be doing a webinar in a few weeks where you can get, just more information just like this, but even better. Well, I don't know about better, but just as great. Guys, have a great night, and thank you so much. And again, Mark, thank you.
Thank you, everyone. Thank you.
Have a great
Kevin.
night, guys.